Sonali Basak, who covers U.S. insurers. Well, some of them are rebounding quite handsomely today, Sonali. I guess investors are relieved that it could have been a lot worse for their companies.
It definitely could have been a lot worse. Over the weekend, the estimates were as high as $200 billion for total economic losses. Now, actually, Enki's research shows that $50 billion, $49 billion is actually total economic losses projected. So of that, about $19 billion will be potentially insured losses. Now, the estimates are kind of across the board. We have some as low as $10 billion in insured losses and some as high as $40 billion. But to be sure, this definitely still is one of the most expensive storms in history, right? By comparison, Katrina was $118 billion with about $50 billion of that insured. We had Andrew at about $47 billion with about $24 billion of that insured. So it is still among the top five.
Yeah, and you can see that actually from catastrophe bonds. This chart, 7514 in our Bloomberg chart library, shows those previous hurricanes and what they did to the cat bond market. And obviously we've seen this huge plunge here. So Sonali, which are the insurers that should get most affected?
So companies like Ren Re, Everest Re, I mean, these are all very weighted in the Florida market. The thing that's interesting about insurance companies in Florida, many of them are heavily reinsured through traditional reinsurers like Ren Re, but then also through the cat bond market. Friday's figure of the 16% drop was the biggest ever drop in the Swiss Re cat bond index. But now we're hearing that, some bonds might be wiped out, but given that the losses are going to be a lot lower than what people were thinking on Friday, a lot of capital might actually flow into the industry at this point because it's enough to wipe out some bonds, but definitely not enough to really wipe out the market. That's for cat bonds and for reinsurance companies. People were thinking into Friday, if losses were this bad, some companies may have to raise capital. People are not as worried about that anymore.
Well, that's what I was just going to ask. Is the market maybe a little bit too optimistic, given that we've literally only just reached peak hurricane season? There's still, some season to go, and we've already had some disasters.
Right, absolutely. So we have to see what the next couple hurricanes will bring. I mean, that definitely is a factor here. But we have to remember, Hurricane Harvey and Hurricane Irma, people are thinking that's about $60 billion in total losses altogether for the insurance industry to incur. So it is quite a lot of losses we've seen already. And because the risk has been so distributed, these companies have been able to stay strong. They're seeing it as an earnings event, but definitely not a capital event, according to S&P. So that will definitely be able to, it's tested the strength of the industry, and so far it's been resilient.